Welcome to the deep dive. We're jumping straight into Starbucks' fiscal 2025 results today. The big question, is this back to Starbucks turnaround plan actually working?
Well, there's definitely something to talk about. The headline number is a win for them, I'd say. Global comparable store sales grew 1% in Q4. That's the first positive quarter in 7. So yeah, the engine's starting.
It is starting. But here's the catch, and this is what we really need to unpack. Despite that top-line win, the bottom line, it took a real beating. So is this just the cost of doing business for a turnaround, or is the strategy itself maybe too expensive?
Let's break down that top line first, because
Yeah.
stopping that slide, 7 quarters of it, that's significant. Q4 consolidated net revenues hit $9.6 billion. That's up 5% year over year.
And that global comp growth, the 1%,
Yeah.
driven entirely by transactions, right? A 1% lift there, too.
Exactly. And that transaction growth, that's kind of the proof point management wanted. It suggests the focus on customer experience is bringing people back. Even in North America, the U.S. specifically, comps are flat, 0%. But that was actually better than analysts were expecting.
That flat number is interesting, though, isn't it? Because it masked a bit of internal movement. They had a 1% increase in average ticket, which offset a 1% decline in transactions earlier in the quarter.
It did. But the recent trend looks better. Management pointed out that U.S. company-operated comps turned positive in September. That was driven by transactions picking up, and they said that strength carried into October. So the last part of the period showed some real momentum.
Okay, so top line stabilizing, maybe even accelerating a bit.
Yeah.
But then, the profitability puzzle. Despite the higher revenue, the Q4 non-GAAP operating margin, it dropped massively, 500 basis points year over year.
Yeah, a 5 percentage point fall. That lands the operating margin at just 9.4%. Pretty lean.
And that really flows through to the earnings per share, the EPS. Non-GAAP EPS was 0.52 cents. That's down 34% from last year. A huge drop.
Huge. Now, it wasn't totally unexpected given the investments, but the sheer size of that decline, it highlights the cost of the strategy.
So what's driving that margin pressure? Two big things, it seems. First, inflation, still biting, especially coffee prices plus tariffs, stuff they can't fully control.
Right, that's the external piece. And the second piece is internal, the thing they do control. Heavy investment in the back to Starbucks strategy itself. Primarily, that means more labor hours, better staffing, faster service.
And the outlook there isn't great, is it? The CFO was pretty blunt about coffee costs, said they expect coffee prices to remain a headwind through at least the first half of fiscal 2026.
Yeah, so these high costs aren't just a blip, they're baked in for a while. Which is why management is being cautious with forward guidance. They're explicitly saying earnings will lag the revenue recovery. Those labor investments need to annualize, meaning they'll weigh on profits for the next year.
It really puts the focus on investor patience, doesn't it? They're basically asking the market to accept these lower margins now, betting that the improved experience will pay off later in sustained transaction growth.
Exactly. And they admitted turnarounds are tricky. Recoveries are not always linear, was the phrase, I think. We're not getting a new long-term financial outlook until the investor day in late January 2026.
So the message is, trust the process, the investments are working, but buckle up for the bottom line results for a bit longer.
Pretty much. Now, if the U.S. was flat, where did that 1% global growth actually come from?
Good question. That takes us to the strategic pillars, and pillar one is clearly international performance. International comparable store sales, up 3% in Q4. That segment delivered a record $2.1 billion in revenue.
And again, driven by volume, international comparable transactions were up 6%. Interestingly, though, the average ticket internationally dipped slightly by 3%.
So more visits, but maybe slightly smaller orders. Could be economic pressure, maybe promotions.
Could be. Reflect the global picture, perhaps. But the standout internationally was China. China comps grew 2%. That's the second positive quarter in a row there. And that was fueled by a huge 9% increase in transactions. Massive volume.
Wow, 9% transaction growth, even with all the local competition they face there.
Absolutely. And they're still expanding physically across 8,000 stores in China now. But here's a strategic shift. They're looking for a partner for the China business.
A partner. Now, when growth seems to be returning, why?
They plan to keep a meaningful stake, so it's not a full exit. It could be about de-risking, maybe sharing the capital burden for future expansion, or maybe bringing in more local expertise.
Makes sense. 8,000 stores is a massive operation to manage, especially in that complex market.
Yeah, management sounds confident long-term, but a partner could provide stability and resources.
Okay, let's swing back to the U.S. and the operational side, the cost center, if you will, this
Yeah.
green apron service rollout. What exactly is that in simple terms?
It's basically their new standard for in-store operations. Think more staff, more hours, focused on speed and a better customer experience. It went live across all U.S. company stores in August, so its full cost impact hit in this Q4.
Right, hence the margin pressure we talked about. But are they seeing results from it?
They say yes. They mentioned throughput metrics, something called the Smart Queue sequencing algorithm.
Smart Queue. Sounds very techy. What does it do?
It's an AI system, apparently. It helps baristas figure out the most efficient way to make multiple complex orders, especially from digital channels and drive-thrus. Instead of just one drink after another, it batches and sequences tasks to save time.
And did it work?
According to them, yes. Since implementing Green Apron service, they said over 80% of U.S. company stores got average in-cafe service times down to 4 minutes or less.
4 minutes?
Yeah.
Consistently. That's actually pretty impressive given how complicated some orders are now.
It is, and they linked this improved operation to better internal metrics, too. They reported record low hourly staff turnover and better customer experience scores in Q4. So happier staff, happier customers seems to be the idea.
Okay, so the investment is yielding operational improvements. But there's another part to this operational reset, isn't there? The store closures.
Right, the portfolio rationalization. This was the cleanup phase. They closed 627 stores globally in Q4 as part of a restructuring, and over 90% of those were in North America.
That's a lot of closures. Were these just underperforming stores?
Pretty much. Management said they closed stores that didn't have a clear path to profitability or couldn't deliver the kind of customer experience they're aiming for now. You can probably guess these were older stores, maybe without good drive-thrus or ones struggling with the digital order volume.
So cutting the drag from the system. Makes sense strategically, even if it looks like a step back in store count.
Exactly. The North America company store count actually dipped about 1% for the full year because of this. But the idea is that shedding these less optimal locations will be slightly accretive to overall profitability going forward. Fewer problem stores to manage.
Right. Okay, let's shift to innovation and digital. How are they trying to drive those transactions beyond just faster service?
Well, on the menu front, they launched that protein beverage platform in September. Protein cold foam, protein lattes. And management specifically mentioned this as bringing in less frequent customers, people looking for something functional maybe.
Interesting. So not just catering to the loyalists, but trying to broaden the appeal. And what about value? That's always a big topic for Starbucks.
They highlighted improvements there, said value perception strengthened across all age groups in Q4. Part of that was simplifying some pricing, but the big headline move was dropping the extra charge for non-dairy milk.
Ah, yes, that got a lot of attention. A symbolic move, but also a concrete cost saving for many customers.
Definitely. It addresses a major friction point, particularly for younger customers. It signals they're listening, trying to remove those little annoyances that add up.
And the digital foundation, the rewards program, still strong.
Seems stable. U.S. Starbucks Rewards active members grew 1% with quarter-over-quarter and year-over-year, reached 34.2 million people. Huge base.
That loyalty base is critical. But what about reaching people outside the app, like delivery?
Delivery is becoming a massive part of the business. The U.S. delivery side grew nearly 30% year-over-year in Q4. For the full fiscal year, it surpassed $1 billion in sales.
$1 billion just from delivery in the U.S. Wow. That's not a side hustle anymore.
Not at all. And it suggests that the operational improvements, that 4-minute service goal, are actually helping them handle the complexity of integrating delivery orders with everything else.
Makes sense. And one last piece, the packaged goods side.
Channel development. Yeah, that was strong too. Net revenues up 17% in Q4, mostly driven by their Global Coffee Alliance, selling packaged coffee and ready-to-drink stuff in grocery stores and elsewhere. Shows the brand power extends well beyond the cafes.
Okay, so let's tie this all together. We started with that core tension.
Right. Top-line growth is back. Global comp's positive. That's the critical milestone they needed. It does seem to confirm that the back to Starbucks focus on operations is driving traffic and improving service. The flywheel is turning.
But the financial piece remains the big question mark. Profitability took a nosedive because of the investments.
It did, though they are trying to manage costs elsewhere. Management said they expect future G&A expenses, like corporate overhead, to be lower than fiscal 23 levels. They're simplifying support structures, trying to find savings to help offset those big labor investments in the stores.
And as a signal of long-term belief, they raised the dividend again, right, 15th year in a row.
Yeah, that's management saying, look, things might be messy quarter to quarter right now, but we're absolutely confident in the long-term cash generation of this business.
So Q4 was the turning point for revenue, no doubt about that. The challenge now shifts entirely. Can they protect and eventually rebuild those squeezed profit margins?
That's the whole game now. Management is betting that better service will keep driving transactions faster and faster.
But with inflation still sticky and those labor costs fully hitting the books now and into 2026, here's the final thought for you, the listener. Will that flywheel of better customer experience spin fast enough in the next few quarters to actually overcome those cost headwinds? Will they get back to margin expansion soon? Or will the pressure build to maybe pull back slightly on those service investments to satisfy the bottom line?
That's the billion-dollar question, isn't it? We'll get a clearer picture, hopefully, with the new guidance in January. Thanks for diving deep with us today.